Hi there. Welcome to our next edition of webinar series that the Center for Energy Studies at the Baker Institute has been hosting. We're very pleased to have a fantastic panel with us today to discuss, in conjunction with the Environmental Defense Fund, a recent study that was completed by Gaffney Klein and Associates on flaring, specifically looking at best practices and how to actually eliminate routine flaring, particularly in the Permian Basin. I'll just let everybody know real quick, we are waiting for one of our panelists to join. He is evidently having some technical difficulties, which is not to be too unexpected in the current world we live in, but I'm sure he will be here as soon as he possibly can. I'm Ken Medlock. I'm the director of the Center for Energy Studies here at the Baker Institute, and I'm pleased to be joined by a just fantastic group. We'll begin with a discussion of the study that I mentioned a minute ago by Gaffney Klein and Associates. Jennifer Stewart will lead that presentation. She is the Carbon Management Strategy and Policy Lead at Gaffney Klein and Associates. And then we will move to some brief remarks by several folks who were engaged at various levels with the work that Jennifer led at Gaffney Klein and Associates. We'll hear from Jeff Gustafson, who's the Vice President at Chevron North America Exploration and Production Mid-Continent Business Unit. Colin Layden, the Director of Regulatory and Legislative Affairs at the Environmental Defense Fund. And Dave Maccarone, he's a Managing Director at JP Morgan Asset Management. The last decade or so has just been utterly astonishing with regard to what's happened to the U.S. and more generally North American upstream landscape. The shale revolution, as it's been referred to, saw tremendous increases in both oil and natural gas production. But of course, we're also very aware that the growth in oil production in particular has led to a dramatic increase in flaring of natural gas from those oil-directed developments. A lot of this has been blamed on lack of takeaway capacity, but as we'll hear today, there are solutions to effectively, there's really no better way to put it, the waste of a resource that is otherwise monetizable. So with that, I'd like to actually go ahead and hand the floor over to Jennifer. Jennifer, you put to go ahead and take control of the screen, and you can unmute yourself and drive forward.
Good afternoon. So thank you very, very much, Ken, and I'm so happy to be here. We're very proud of this report. Would not be possible without the support of the Environmental Defense Fund, JP Morgan, and the operators who participated in the study. So we'll dive right in. We'll try to dive right in. So there's quantitative and objective data out there that demonstrates or shows very clearly that there are top tier operators in the Permian Basin with respect to flaring intensity compared to the average rate of about 3.7%. And those are on your screen right there. And those are the 5 producers that were so gracious and willing to talk to us candidly, transparently about what are they doing to achieve these results. So we have objective and quantitative data, but we were really interested in the subjective and qualitative data. How did these results arrive, or how did these producers get to these results? Was there a silver bullet? What was the answer? So a couple points just in this particular graphic right here is that size didn't matter. When we came to the answers, size didn't matter. Your geographic footprint didn't matter, whether you were an integrated or independent, a Permian only producer, or if you had assets all over the world. Size didn't matter in approach. And then finally, with respect to the data, just wanted to clarify the data that we used. It was public data available from both Texas and New Mexico. We know there's different ways to measure flaring intensity, particularly with respect to what's in the denominator, but we use the gas production in your denominator to normalize across all the producers, and then be able to benchmark back to the public data that New Mexico and Texas provide. So here's our 5 producers with their amazing results. So what do we find? The data gathering process, when it began, it had a lot of questions about what kind of cool new technology are you using? Are you using microscale LNG? Are you using CNG? Are you on-site power gen? Using gas for enhanced oil recovery, injection? What are the cool new tools you're using? And the answer was, with respect to some minimal investment in some of these technologies by some of the companies, it was none of those. The 3 keys to eliminating flaring that we found were these 3 categories. And I'll talk about each one briefly. But first, it's a strong governance. It's a culture issue. It's strong governance and a commitment to environmental stewardship from the board all the way down to the field operators. And that then ties into the second bullet point, which is that strong governance drives a commitment to reduce flaring. And that means you don't put a well online until you've got takeaway in place. That takes a lot of, I'll go into it a little bit more, but that's a huge commitment that's made, again, from the board all the way down to the field operators. And then finally, when you have to flare in the case of operational upsets or safety issues or high pressure gas lines, then these companies also utilize best practices that we'll share briefly when you do have to flare for safety reasons, or what we would call non-routine flaring. When a field operator is out in the field and is under huge pressures, both time pressure and cost pressure, particularly in today's environment, and they have a choice to make when they're out in the field with respect to flaring. If they see an unlit flare, a malfunctioning flare, they see any type of equipment that might need functioning, they've got a choice to make. So what decision will they make? And that decision will reflect the culture and the organization of a company. So again, I can't stress enough that a company can have a culture of environmental stewardship, but unless it's all the way down to the field, it's at every level of the organization, it's not going to be effective. And what we found with these 5 companies is that they did have these cultures that was effective. And so here are the highlights of what we found that were strongly indicative of a strong governance culture and a strong culture of environmental stewardship. And I will key in on the last 2, which I think are the most impactful, and we'll talk a little bit more particularly about the second one from the bottom. The first is setting an aggressive flare intensity goal. And each of the companies that we talked to had different ways of doing that. Some had a year-over-year reduction, some have an absolute target reduction, some have a commitment to zero flaring, some have an intensity. We're at this intensity this year, we want to get to that intensity next year. They all approached it differently, but they all had the same mindset, in that each of them, in my view, based on the understanding and the knowledge that I gained from this study, were aggressive goals. And those goals serve 2 purposes. They create transparency to all stakeholders, and they create accountability, in particular to accountability within the organization and without the organization. Once you set a goal and you make that transparent and public, then you're accountable to everyone who knows about that goal. And then lastly, tying compensation metrics to these flaring goals that have been set, however that works. That's another commitment of the board, and particularly senior leadership, of their commitment to reducing flaring. If your comp is tied to an achieving result, you are very incented to make sure that that's the right result. And at the executive level, the board of directors has to approve these compensation metrics. So it starts with that strong governance and strong leadership from the top. And as we go through these slides, I'm doing a quick overview of the report. There will be at the end of this deck, there's a link to the report. It's on LinkedIn. I can email it to you. It's available today. Again, these are very high level. There's much more detail in the report. It's 21 pages long. So this is just a preview, just to, if I'm glossing over some of the bullet points. So the silver bullet. Well, the silver bullet is to not flare at all. And so I heard it once, twice, 3, 4, 5 times when I talked to all the people that I talked to. The silver bullet is to sell your gas. if your gas is going to sales, the dilemma on how to manage flaring goes away. And that was what all the producers told me. If that's not a one and done situation, that's not an easy strategic leadership decision to make. It takes a lot of work and a lot of commitment, but these 5 companies have done it. So all 5 companies have made the commitment to hook up their gas wells, to hook up their wells only when they've got a place to take their associated gas. And that means a willingness to shut in. If there's no takeaway, then we're not going to put the well online. We're willing to shut in. Now, what I did find is that these companies are sophisticated enough and their planning is robust enough that you're not going to have a well go online and then have to shut in. That just doesn't make sense from an economic perspective and from a planning perspective, but the willingness is there to do it. And again, all the way down to the field knows I can shut in. And then another interesting concept that I learned is that takeaway should be perceived not as a barrier. We keep hearing takeaway is a barrier. It's a barrier. That's why we're flaring. All of these companies saw takeaway as not a barrier, but a constraint. And one producer gave an awesome analogy, which was permitting. You can't construct a pad. You can't build a lease road. You can't drill a well without a permit. But is that a barrier? No, that's a constraint that you manage and that you plan around, and you run into difficulties, you run into permitting issues, you run into landowner issues. It's a constraint, but you work around it. And how you work around that constraint takes extensive planning, communication, and equipment and commitment. And so we'll talk about each of those very briefly. What I mean by planning is that one producer made the comment, it's not a surprise when your well goes online. It's not like all of a sudden you wake up one morning, oh, my well's on. You know this maybe years in advance. Most of the companies have production schedules that are 1, 2, 3 years out. You know when a well is going to go online. So it takes planning to get your infrastructure in place. It takes communication within the company. And again, it takes a commitment to not flare. And so we would be remiss to not talk about how you get your gas to takeaway. And so the 5 companies approached it differently depending on their business model. And some use midstream companies to gather and process their associated gas. And those companies stressed, again, it was so interesting to hear the exact same words coming out of different individuals from different companies' mouths, is that a strategic, trusting, long-term partnership with your midstream company is you have to have it. You can't have a hostile tactical arrangement where your only goal is to take hydrocarbons away. Your midstream company has to be in partnership with you, understanding your production schedule, understanding your commitment to not flaring and why you want to not flare, and mutual trust between the 2 companies. Without that, there seem to be inferences that without that kind of trust, that's where, if you don't own your own midstream, that's where things break down. And then at the other end of the spectrum are those companies that use an integrated model. They own their own gathering, processing, or compression, and that way they've got their own takeaway. For some, it opens up multiple markets. It gives them more control over downtime, over repairs and faulty equipment and that stuff. And we'll talk about that a little bit more. But this is if there's a key slide in this whole presentation and a key takeaway to the paper, it's this right here. And then the last tenet, or the third theme that we came across, were best operating practice. So at times, producers have to flare. Operational upsets, high gas line pressures, or safety reason, you have to flare on a non-routine basis. So the question became here, what are your best operating practices when you have to flare to ensure combustion efficiency and just to ensure that you're doing the best you can to eliminate your flaring and to increase your combustion efficiency. And so I have a quote from Chevron, which I dearly love, and it's in the report. The most efficient flare is one that isn't taking volumes. So that was just awesome. That doesn't answer the question of when you have to routinely or non-routinely flare. But again, I asked the question of all the producers, how are you dealing with combustion efficiency? Because the two recent reports that are studies that are cited in the report both address either malfunctioning flares or unlit flares as a real area of concern with respect to methane emissions in the Permian. So we really wanted to know what were companies doing to eliminate inadvertent venting and malfunctioning flares that may have a lower combustion efficiency. So few takeaways here. The first one is, and in the report, there's a graph that has, I think, 12 different best practices. We won't go into them here, but trained staff or contractors was cited as the best preventative measure to ensure flare efficacy from a cost perspective and from an efficiency or an effectiveness perspective. And that's just basically, that's old school using AVO, auditory, visual, and olfactory senses to see if something's working or not. And then the proactive bullet references not being able to use operational upsets as an excuse. So if you don't own your own midstream and a compressor goes down further down the line, then there's going to be knock-on effects that are coming all the way up to your pad, which may have to cause you to flare because of the high pressures or other reasons. All of the producers, whether they own their own equipment or not, took a very proactive, strategic approach to managing these operational upsets. They planned for them. They assumed they were going to happen. They were in constant contact with their midstream companies. They were very agile and nimble. If a gatherer had a gatherer had an issue with the compressor, the compressor was faulty, there was a problem, and they didn't even own the compressor, they might go out and fix the compressor themselves, or they may even install their own compressor, even though they're contracted with a gatherer to use their compressor. So none of the producers said, well, we have operational upsets, therefore we have to flare. They said, no, they said we have operational upsets, but we plan for those, and we plan our operational strategy around handling those. And then finally, the use of vapor recovery units was, everyone used vapor recovery units, and the intention, some use on all pads, some use, one producer said they put them on all pads regardless of the economic value of the VRUs. Others have them on up to 90% of their pads, and they all have the intent of achieving maximum capture efficiency. And the report goes into a little bit more detail about the practices of some of those producers, how they are really stretching the bar on using their VRUs or doing more than what they need to do. And then finally, beyond operational and environmental issues, what else is out there? Well, all the producers were able to make a very clear bridge to a beneficial financial impact of what they're doing. And that's in three ways. It's a financial statement impact. I mean, just protecting cash flow. I've retired from a producer in December of last year and was there for 10 years. And I know cash flow is king, and selling your gas is accretive to your bottom line. Risk mitigation, and that serves two purposes. One, an investor, a long-term investor, is going to be in, they want stability. They want to know you're in it for the long term. And so these practices ensure long-term investment stability for those investors. And in addition, it goes without saying, I have it on here, but your social license to operate in the communities where you do business it's a huge risk mitigation factor. And then access to capital markets, if they ever open again, it would be hopeful that these practices and these track records, particularly when you benchmark them against peers, will facilitate access to capital markets. It's going to lower your bank risk profile when they go to set the terms of your credit facility, and then it may even, in a perfect world, drive a premium to multiples with respect to your stock price. So with that, I will close. I thank you all very much for the opportunity to present this study. Again, I thank EDF, the 5 producers in the study, and the Baker Institute for allowing me to present what we found. And I look forward to more discussion.
Great. Thank you, Jennifer. And if you could unshare your screen, we'll... Perfect. Okay. Well, I'm happy to say that Jeff was able to join us. I think you might have logged in as a participant, so we couldn't see you, but you could hear us. So you heard all the crazy things we said about you in the intro.
I did. Can you hear me, Ken?
Yes, I can hear you fine.
Okay,
You sound great. So a couple of questions came through. I'll just address real quickly. The event website on the Baker Institute platform actually has a link to the study as well as the presentation that Jennifer just showed. So all of that is actually available for download. So feel free to go there to check it out. So lots of requests were coming through, Jennifer, about the slides, which is why I mentioned that now. So what I'd like to do now is actually turn the floor to Jeff and then Colin and then Dave, just to make a few opening remarks, reflections on what Jennifer said, but also thoughts about the issue more generally. So with that, Jeff, I'll hand it over to you.
Thanks, and sorry I probably scared you and not being there when you expected me to. I heard everything. I was just logged in the wrong way. You'd think I'd have that figured out after about 10,000 video calls over the last 3 months, but Zoom is not our preferred platform. So there was a little bit of a learning curve. I apologize for that. But Jennifer, that was great overview. I think the report is great. One of the things that one of the easy, there's no easy fix to this issue. It'll take a lot of work, but it is a fixable, manageable issue. And part of the solution is providing some of the information that you did in the report. And that's not a hard thing to do, but sharing best practices and the like with all the operators that are out there is a great, easy step to take. Just to give folks a little bit of a sense of where I'm coming from. So Chevron, vice president of our Mid-Continent business unit, which used to be really the lower 48, all of our onshore upstream activities, exploration and production activities. Really now it's effectively the Permian Basin and our interest there. We do have other assets in East Texas, Colorado, a little bit in Oklahoma, but most of what we're doing now is focused on the Permian in West Texas and Southeast New Mexico. We have a very large position, over 2 million acres. We were running at very high activity levels, up until recently when we scaled back just to deal with the market environment that we're in. And we still have very significant volume growth plans. We were planning on hitting some very production milestones, 600,000 barrels of oil equivalent a day this year and up to 1 million in 2024. Obviously, those are being reworked now in light of the environment that we find ourselves in. But one of the larger players, and this is one of the probably most important assets in the company. I'm not saying that because I'm biased. It is, and that's in a very large integrated global company. The reason why I say that is it gets a ton of attention, as you can imagine, inside the company with everything that we do, and a ton of attention with our external stakeholders, especially the investment community. And more, the questions and the focus is in not just the flaring direction, but in our environmental performance more broadly. That's true of the company, it's true of the industry, and it's certainly true of what we're doing in the Permian. For flaring in the Permian, this is a significant issue. That seems like an obvious thing to say, but the volumes, if you look at last year that were being flared and emitted, was really staggering in an absolute sense and growing. The environmental impact is real. With this, there's no debate on that, and the economic impact is real. And Jennifer touched on both. There's two aspects to that. One is you're burning product which has value. There were times last year where it had negative value, or it was you had to pay someone to take it off of your hands. Those were very unique periods and very temporary periods of time. This product has value, and it's not being realized by the company or our stakeholders. The other source of economic value is the indirect, is the market's view of this, and the growing scrutiny on this, not just for an individual operator in the basin, but across industry. And that's having an impact on capital markets. And this is not just flaring in the Permian, but this is one of of other issues that industry is working hard to address, capital flows are changing because of this. That has a real economic impact. Maybe it's less so on a larger company than a smaller company. There's obviously a mix of impacts, but that is absolutely real. I think we all know how or why we're here. You know, the boom in the shale revolution, Ken, you mentioned that, has been faster, more significant than I think anyone realized. The productivity of the individual wells has also been greater, and it continues to improve our results and other results. And in some parts of the basin, the gas content has been higher than what was expected. And this is complicated because of the different layers that we're developing, especially on the Delaware side of the basin. And the infrastructure has lagged, but the facilities infrastructure, in some cases specific to a company's development, but also down the value chain with pipelines and even LNG export facilities. Prices then declined significantly. I talked about negative prices at Waha, the big natural gas hub, a couple of times last year. Or takeaway's been difficult to find at a reasonable price. So that certainly had an impact. But there's a big economic driver of why we are where we are, but this is a manageable problem. And I think the best proof of that is the slide that Jennifer put up with the 5 companies that she spoke to. And I'm not tooting Chevron's horn here, but there are companies, large and small. Very important point, Jennifer, that this is not a big company issue or small company issue. Companies are effectively managing this if they plan appropriately, and the economics are not insurmountable. Even last year, when you run into those very extreme market environments, that is challenging, but they tend to be very temporary and are not the norm. You don't need that high of a natural gas price in the basin to make some of the investments that are necessary and some of the actions economic. But you have to plan out for those. So it is manageable. It will take a lot of work. There's a lot of different involved here, a lot of foresight planning, some investment. Certainly it takes commitment. Jennifer, you made that point, commitment from the top, target setting and active tracking of how we're performing. That is something that's growing rapidly. The partnerships across the value chain are also important, particularly upstream to midstream. And there are many different players in between, and that extends all the way to the coast and some of the LNG export facilities. And there are external stakeholders that are really, really important here. Some of them are on this panel, regulatory bodies, other environmental stakeholders that helping to drive a better outcome. We're in a down period now, certainly with what's happened with COVID-19, but the Permian will absolutely be back in a big way. So we need to make sure we take this unique opportunity, this unique environment that we're in, to keep the momentum going in this space, so we come out of this downturn in a better space than how we went into it. And I think this is certainly one of the most important issues we're facing in the Permian, and it's a pretty big issue for the industry as well. I'll stop there, Ken, and I'm happy to take questions. I think we'll do some questions later in the panel.
Fantastic. Thanks, Jeff. Those are great remarks. And yeah, I'm gonna go to Colin and then to Dave, and then we'll jump right into Q&A. I've got a few that have come through that are really interesting. I think it's gonna be nice to hear from Colin and Dave, because it'll allow some of the questions to pull a thread through all of your remarks, I think. So Colin, take it away.
Yeah, thank you. Hi, Colin Layden from Environmental Defense Fund. Want to give you kind of a quick overview of how EDF thinks about flaring and has been thinking about flaring. And first, though, a big thank you to the Baker Institute for hosting us today, and Jennifer and Gaffney Klein for compiling the report. And a special thank you to the operators, Chevron, Pioneer, Parsley, EOG, and Oxy, who are willing to share all the institutional and operational practices that they've implemented to significantly reduce and maintain a low flaring footprint. So EDF, applauds the steps that they've taken to tackle this issue. So we've been engaged on the flaring issue since the beginning of the U.S. shale boom. Like industry, the investment community, many of the other stakeholders, we've been focusing most recently on the large amounts of flaring happening in the Permian. Over the last 7 years, operators have burned roughly 1 trillion cubic feet of natural gas in the oil field. That's gas, as others have mentioned, that hasn't been put to any kind of a productive use, and of course is a major source of pollution. So the environmental harm of flaring is obvious. It's a source of local air quality pollution. It's even a larger source of climate pollution than even we expected. And hopefully we'll talk a little bit more about that later in our discussion. But essentially, our work has, recently shown that flares appear to have a significant performance problem, which is contributing to methane emissions in the basin. So at the heart of this whole thing, flaring problem has an incentive problem. You've got low gas prices, rush to bring production online, a lack of meaningful regulatory limits, and that's all a recipe for excessive waste and pollution. And that's generally what we've seen in the Permian. Operators are primarily there for the liquids, and the dry gas can often end up essentially being a waste product. So the report highlights many of the solutions, as Jennifer pointed out, and some companies are really prioritizing these and making their investments work. But we also know that there are other companies that simply accept this practice, as it costs virtually nothing to simply burn the gas. At the same time, we're in an environment where industry is facing increasing pressure from investors and a large growing set of stakeholders to improve their ESG performance. And frankly, flaring is a huge unforced error. It's a big burning question mark hanging over the oil and gas industry's ability to compete in a low carbon economy. And like many practices that were once taken for granted as just business as usual, the casual handling of disposal of produced water way back when, and then more recently methane emissions, we believe at EDF that routine flaring needs to end entirely and be a thing of the past. To put flaring in the rearview mirror, we need concrete measures that include all operators, not just the best, like the ones featured here in the report, and the more forward-thinking ones. And frankly, that's going to require a strong stand from regulators, in our opinion. And they can be inspired and guided by the strong flaring work of these companies that are on the leading edge. But we're not going to change the underlying dynamics here from EDF's perspective without regulators taking a stand and saying this just can't go on. And that's why EDF's ready to work with the regulators here in Texas. The issue's been getting a lot of attention at the Railroad Commission, and in fact, it'll be on the item. It's an item on the agenda on June 16th. So that's why EDF's willing to work and wants to work with regulators, industry, the investment community to put in place the policies, the incentives that will eliminate routine flaring in Texas by 2025. And I'll stop there, Ken.
Great. Thanks, Colin. You actually started to pull on a thread that I'm going to basically yank on pretty hard, actually, after Dave talks, which gets into the role of the regulator and sort of some synergies, if you will, between actions being taken in industry and what the regulator can do to help accelerate some of these positive movements. So, but before we get there, Dave, please go ahead and take off. I think you're muted. There we go.
Okay. Thank you, Ken. I'm David Maccarone, equity analyst at JP Morgan Asset Management. I want to thank Ken, the Baker Institute, and the Environmental Defense Fund for allowing us to be a part of this initiative. I'll try to reinforce the comments we made in the forward to the report that was published. Big picture, when we look at and analyze energy stocks, we also are evaluating a variety of sustainability factors. And when we look at the Permian, we see economic waste from gas flaring. And, the interesting thing to us is when done to best practices, the Permian can be one of the lowest environmental costs of extraction globally and generate among the highest returns on capital in the world. And so that's why it's so important from our perspective as investors. You know, and so we do support policymakers developing regulation to deliver on the objective of zero, non-routine flaring or zero routine flaring, and in the Permian. And the reason why is voluntary actions have not delivered the change that is possible. We have to realize that the oil and gas sector as a whole faces a variety of risks in terms of maintaining this societal license to operate. And that will come into question over time if industry performance does not improve. So zero routine flaring can really deliver benefits in the form of reduced costs to the industry, as we talked about, as well as delivering environmental benefits. The reality is climate change needs to be high among companies' priorities because the world is changing. And that's because these changes will drive company operations and stock valuations. And for us, that's why it ultimately matters so much. It impacts our ability to create value for our clients. So I'll close with that and turn it back to you, Ken.
Great. Thanks, Dave. So real quickly, before we move into a deeper line of questioning, Jennifer, I want to direct one to you just because it's pertinent to the study. And I think anybody on the panel could answer this, but maybe it's best coming from you given authorship. Some people are asking how you distinguish between routine and non-routine flaring and what the measurement is there. And I think that's actually a useful sort of jumping off point. So if you want to elaborate on that a little bit, that would be great.
So from my perspective, it's easier to put it in what is non-routine flaring. So non-routine flaring is when you flare because you have an operational upset. You've got your processing side is down, your compressor is down. There's high pressure on the lines, or maybe there's too much gas coming in, and there's high pressure on the lines, causing you to have to flare, which you wouldn't normally. And then just for safety reasons. And I think there's some temporary flaring, when you first put a well online, and this may be a day or two. And then sometimes there's just reasons when pressure builds up, you have to flare. So in my view, that is non-routine flaring. And then everything else is routine flaring. So I don't know if particularly Jeff, you're more qualified than me to answer that question, but that's how we made the distinction in the paper.
Yeah, it's an interesting, there's a spectrum right here. I mean, you think of routine as just folks out there just flaring because it's, better than maybe the economic rent they can gain by selling the product, or and certainly that's maybe on one side of the spectrum. But, it's more complicated than that because, and when I talked about planning, this out, having everything synced up, so you're not obviously bringing a well on, or if your drillings and completions are running faster than maybe the facilities, you allow those things to catch up before you actually bring the well online to limit, maybe a brief period of time where you need to do some flaring. There's also, if a compressor goes down, well, what's the sparing strategy? This is a big part of our strategy where we want to own. We do rely on midstream service providers and a lot of different providers to provide services to us. There are pieces which we really want to own and control. That requires more upfront capital, but we think we can then operate it more reliably, and we can have a different, for instance, sparing strategy. So if a compressor goes down, you've got one available sooner to prevent, for us, shutting the well in for an extended period of time. But if you're maybe another operator going to the flare, I think of non-routine as being the real operational, upsets that really can't be, foreseen and are harder to recover from once they've occurred. But I think I think we have to be careful when we say routine versus non-routine. There could be many different definitions depending on who you talk to.
Yeah. Thanks. So real quickly, I mentioned the thread I wanted to pull on. It really gets to the role of the regulator, and there've been quite a few questions that have come through asking questions about, for example, why some of the larger oil producers and even some of the mid-size and smaller oil producers in the Permian in particular have taken steps to meet this challenge, even in the absence of stricter regulations on flaring. I think it's also important, maybe if you can address it, the degree to which the regulatory environment can vary across state, because the license to flare is something that is given by a regulatory authority that's local, in your remarks. And I know, Colin, you mentioned, one of the items on the agenda for next week's Railroad Commission hearing is the flaring issue. And I wonder maybe if you could elaborate a little bit on EDF's stance as well on this issue and what the role of the regulator is. And to the extent that all of you have something to say about this, I'd love to hear how it links back to ESG investor guidance, and how that's matriculating more and more into these types of decisions. So whoever wants to take it first, go right ahead.
Yeah, I'll jump in real quick and pick up on sort of the thread that I started there towards the end. So EDF believes that, if we're going to tackle this problem and bring everyone along, that we need to set a really strong and definable goal for where we want to eventually get on flaring, sort of a North Star to guide and focus attention and then ultimately measure success. And so that's why ultimately we'd like to see the Railroad Commission adopt the policy of ending routine flaring in Texas and instruct staff to start developing a pathway for getting there. That's going to be a collective effort. It's an ambitious but achievable, and it reflects where the industry is already heading, right? I mean, there's a lot of companies that are part of committing to zero or near zero upstream emissions, and I think that at least within a large segment of the investment community, that's an accepted place of where the industry's headed. There's probably a lot of policy options along the way to get to that goal. We could talk through some of those, but I'm also looking forward to seeing what the industry panel that Chairman Christian at the Railroad Commission has asked for their recommendations. It'll be interesting to see if there's stuff in there that's a real worthy start here. So look forward to that. And I think it's great to see JP Morgan really stepping up on this issue, because my sense is that investors are asking tough questions about, the oil and gas sector with concerns to ESG. And so for the colleagues out there in Wall Street who want to be part of ESG wins, eliminating routine flaring, it's so ripe. And such an opportunity. It's good for shareholder value, as we've heard. It's good for a license to operate. It's good for the climate, and it's good for the environment. So this is a real easy place to focus on. So we're cautiously optimistic that as more asset managers and investment banks and others dig into this flaring opportunity in the days ahead, that we're going to see a chance to make some tangible, positive difference, and hopefully build sort of a coalition of the willing on this issue as we move forward here in Texas on it.
Thanks, Colin. Dave, Jeff, anything you want to add? Go ahead, Dave. You're muted still. So.
Thanks, Ken. So I think there's an expression: if you aim for nothing, you'll hit it every time. And the voluntary operator actions we've seen have not delivered on the industry-wide change we need to see in time, particularly in the Permian, given its size. So, as it relates to ESG and investing, before ESG was a term, we, in addition to company fundamental analysis, we're always engaged in issues tied to governance and safety, and over time, the environment. And we maintain an active dialogue with managements on these issues, with each and every management that we interact with by call, by in-person meeting, video conferences now. And I think what's changed in recent years is companies, to some degree, are doing a better job disclosing what they're doing. And the ability to quantify the environmental emissions and the various attributes from sustainability factors and compare companies and compare best practices really enables us to have a better dialogue. And I think if there's one thing that we need to see more of is better disclosures and really better measurements of the emissions in this area. I think that's something EDF is working on closely, but it's something that's important to JP Morgan Asset Management.
Great, thanks. Jeff?
Yeah, I agree with that. I think the data, and again, it's not a difficult thing to implement. The data collection and the reporting of it. I think that's already had a big impact in making this really a front page issue. I'd say from a regulatory sense, I need to be a little careful here, but that was certainly something that was that is on the table, that has been discussed. I would say we have been making progress as an industry. If we're not able to get to a more acceptable place here, and some of the data I talked about, this is a problem, then that is something that we need to consider. Our view on regulations is pretty consistent everywhere, that we want to participate in the dialogue to make sure we get to an effective place from a regulatory standpoint, and we're already participating in that with the Railroad Commission, and I know they're very, very interested in this and getting to the right place on the New Mexico side as well, not just in Texas. They need to be balanced as well. They need to balance economics with environmental stewardship. That's always been one of our hallmarks. And I think we just have to take the current downturn into account, because I'm not saying this problem goes away. The numbers will certainly decline in an absolute sense because production's being curtailed, but it's also, the downturn's allowed some of the infrastructure further downstream to catch up to the upstream production levels. And you can already see this in the gas prices in the basin. The differential between Waha and the Gulf Coast is down to 50 cents. We haven't seen that in quite some time. That was $1.50 or higher for a long period of time. And so that is a great economic signal that will hopefully, with all of the other work that we still need to do, I'm not discounting that at all. This market downturn will not fix this, but it certainly provides an added momentum that might change our view of what we need from a regulatory standpoint.
So we've got time for a few more questions, and I'll be very clear for everybody. I think in sum, I'm counting about 90 questions that have come across so far. So I'm trying to get to as many threads as possible. But if nothing else, that tells you how incredibly important an issue this is, that there's that much interaction through the chat and through the Q&A. One of the things that I wanted to ask you, Jeff, in particular, because Jennifer spent a lot of time talking about best practices. And you're obviously highlighted as an example around 1% rate in terms of flaring in the Permian and striving for even lower. You also discussed in your opening remarks a little bit about the planning phase of a development and how you actually work to ensure that there's as few unroutine or non-routine flaring incidents as possible, as well as cutting routine flaring. I guess if you could just briefly talk a little bit about the model that Chevron has applied in the Permian to cut back on routine flaring, and how you think that is unique to Chevron, perhaps, or how you think it might be more generally applied.
And I don't want to. I'll keep it brief. Jennifer touched on a number of these, and there's a consistency among a lot of companies, not just the 5 that she spoke to, and that is growing. So I think you can refer to some of the snippets in the pages in her report. But it all, for us, it starts with that commitment, and you have to. Once you make the commitment, at the very top, even the board, and now of course, David talked about the investor standpoint, this is a very hot topic when you're out on the road talking to investors. A very hot topic, not just this one, but environmental stewardship broadly. So we're getting, that feedback's coming in. Many years ago, we made the commitment before you even started development. Hey, we're not going to flare routinely. That is a guardrail, as we say. Once you've done that and you empower the teams, we've got really innovative, smart folks across industry. You figure out how to do that if that is a guardrail, because you want to avoid the situation where you need to shut in a very profitable well because you don't have a place to put the gas. So once you've made that commitment, and better yet, you set targets. I totally agree with what David said. You can't just, we need to have some firm targets. We certainly have them in across Chevron, globally, and in the Permian specifically. And then if you can link those to compensation, which we've also done, and that's a recent phenomenon for us, and we are a bit unique there, but I don't think we'll be alone. That really drives the action. And then I won't get into all of the different, minutia of how we plan things out. I mean, there are thousands of different lessons learned that we've had over the years to make sure that all of this, that you can avoid this situation. And again, avoid it without a significant economic cost. When prices go negative, that's a different situation, but those are very specific points in time. You don't need a very high, gas price to make these upfront investments work, but you have to prioritize them and you have to make that commitment upfront. So hopefully that provides a little more color. Ken, I think Jennifer's report really lays it out in really good detail.
Excellent. So definitely encourage people to download that from the website. Colin, I want to turn to you real quick because there have been a number of questions that have come through related to distinguishing between venting and flaring. Maybe a data point would be useful just in terms of some of the work EDF's done and what they've seen with regard to flares that aren't operating properly and it results in venting, what that fraction, what that ratio looks like. And then perhaps discuss in a little bit more detail how EDF is approaching both companies and regulators in the state of Texas in particular on this issue.
Sure, thanks. Yeah, so real quick on flaring and sort of the overall contribution. When we launched this big PermianMap.org, I'll put in a plug there, really a big Permian science campaign around methane to kind of quantify and characterize methane emissions in the basin, much like we've done in other basins around the country and the world.
There's a link to it in the report, Colin. So there's a second plug.
There you go. Yeah. And we wanted, because of the attention given to flares, we wanted to figure out, what role flares played in overall methane emissions in the basin. So we did 2 helicopter surveys with an IR camera, infrared camera, to try and get a quantitative look at how the flares were performing. And what we found was really actually pretty startling. We found that between the 2 surveys, which was over 300 flares across the basin, about 11% were malfunctioning at any given time. And within that 11%, 5% were completely unlit. So those are directly venting in the atmosphere. So, that was a surprise even to us. But what it means is that flares really are probably one of the larger sources of methane emissions in the basin, which, was not what the inventories the current EPA inventories indicate. And so, from our perspective, it's at the point now where you can't solve the methane problem without solving the flaring problem. I think that those issues with flares, they're operationally are probably solvable, but I've also heard from operators it's difficult too. It's an intensive matter. So, and as many of the operators have pointed out, if you don't want emissions from flares, the easiest way to do it is to not send any gas through them. So that's what we're finding on how much of a problem flaring is in relation to the overall emissions in the basin. We've also found that overall methane emissions in the Permian are high, very high, some of the largest in the nation, roughly around 3.5 to 3.7% loss rate of gas, which is enormously high and much higher than a lot of the commitments than some of the leading companies have made that are operating in the basin. So there's a lot of work to be done there.
Sure. So we're running up against it on time, but I want to give each of you an opportunity to make just a final statement on this issue, because I think this is an incredibly intriguing discussion, and there's a lot of things that we could continue to talk about. And unfortunately, we're not going to be able to get to the litany of questions that have come through. But I encourage, first of all, everybody to kind of go back through this on our YouTube channel, because this is all video archived. I think there are going to be little bits and pieces that you might have sort of missed over as you were typing a question, or keyed in on something one of our panelists said. There's been a lot of really good information here, so I'm very appreciative to all of you. But before we exit, Dave, do you want to make any final remarks before we close? You're still muted, Dave.
Terrible offender here. I just say a few things. One is we see prudent planning to avoid unnecessary economic costs in areas like flaring. That's just very compelling proposition. When you boil it down, creating value for shareholders is about maximizing return on capital and optimizing the weighted average cost of capital. So to me, making progress on environmental missions like flaring means you can make progress on both accounts, both the numerator and the denominator and all of that. So I'll leave it at that.
Thank you. Jeff?
David, you're making me look good by not being able to log in. Thanks for that. I've said most of it. Look, I think this is a really tough industry, and you're seeing that, in spades right now. We have enough challenges. This shouldn't be one of them. And so this is, I think if there is a silver lining, there are silver linings in this environment that we're in. One of them is it provides time, again, for infrastructure to catch up a little bit from a takeaway standpoint, to do planning, just to stop and think a little bit, not just us, but all the operators, the regulators, everybody that I mentioned, and keep that momentum going. I think we can come out much stronger. But the concern I have is, balance sheets, financials are strained for a lot of companies. That might get harder before it gets better. That is going to be a challenge when we ramp back up again. So that just says we've really got to take this opportunity to keep pushing this forward. We would be very disappointed to come out of this and we're out of the cycle, and the Permian's ramping up investment again, and here we are not making significant progress on this issue. So I'll close it there, Ken.
Great, thanks, Jeff. Colin?
Well, I think environmentalists get accused often of being pretty negative, so I'll try and close on a positive note and say, I think that this report really shows that there's a lot of companies out there that are making tremendous progress. I think if we all work together here in Texas, we can get this done, and EDF, stands ready to help.
Great. Jennifer, you have anything you want to add?
Real quickly, I'll use what my colleague David Delasso used. It's mindset. It's all about mindset. If the company's governance has the mindset that it can eliminate routine flaring, then it will. And it has to start there.
Great, thank you. And I'll just, in closing, say thank you to all of our panelists. Thank you to the Environmental Defense Fund for co-sponsoring this event with us. I encourage all the participants who logged on to watch to definitely go download the resources that are available on the website, and stay tuned to this discussion, because I think everybody intimated this today on the call, but it's an area where there's tremendous opportunity, particularly right now, to take some real meaningful actions in a positive way. So everybody stay safe, and we'll see you next time.
Thank you.
Thank you.